Hello, everybody, and welcome to Commodity Culture, where we break down the commodity space for both new and experienced investors. My name is Jesse Day, and before we get started, standard disclaimer, nothing here is investment advice. Do your own due diligence. And we are back with Andy Schectman, President and CEO of Miles Franklin, for part two of our interview to discuss the silver market and more. Andy, welcome back.
Good to be here again, and thanks for part one. It was great. Looking forward to part two.
Yes, absolutely. So much knowledge shared. So I'm excited to dive in again. And I want to start with the same question I did on gold in part one. And that was, what are the main tailwinds you currently see working in silver's favor, and any headwinds or risks currently facing the sector?
Well, look, as far as tailwinds are concerned, you have what I believe to be the most undervalued asset on the planet, that being silver. Um, we're going to see at least 200 million ounce shortfall between supply and demand. It is an asset that is needed in so many ways, or so many forms of manufacturing, in terms of green and digital applications, and copious amounts that are growing every day. There's 500 ounces in the tip of every Tomahawk cruise missile, or any of these sophisticated like Javelin missiles. They have huge amounts of silver. Google it, you'll see that. And when we've given away so much of our artillery and our weaponry to the Ukraine, the U.S. will need to rebuild its stash. They will need silver. And you know what's very unique about silver is this duality in demand between an asset that's experienced a monetary renaissance and all of the ever increasing industrial and military uses. And in a world that is going green and digital, the need for silver is massive. Now, when you put it in the context geologically, it becomes a lot more interesting. Geologically speaking, the price of silver in relation to gold for 5,000 years has been 16 to 1. There's been 16 ounces of silver in the ground for every 1 ounce of gold. I think the exact number, they call it God's ratio, was 15.5 to 1. So silver, in essence, is much more abundant geologically. But the big deposits were found decades ago, long before the advent of advanced imagery, because the geologic term for silver in terms of where it's found is epithermal, and meaning it's very near the surface. And so last year alone, only roughly 30 to 35%, call it a billion ounces, were mined. Roughly 300 to 350 million ounces came from companies that mine silver, period. The other 650 to 700 million ounces came from companies that don't mine silver at all. They mine other things and stumble across it. Oh, look, we found some silver. It's a byproduct of other elements that are being mined for, which means it's decreasing its footprint in nature. The big deposits which were found near the surface have already been exploited, and now you only get 3 out of 10 ounces that are mined from companies that are looking specifically for silver. So this is a depleting asset in an environment where the demand is increasing exponentially in green, in digital, in military, and in monetary applications. And so if we fast forward to roughly the industrial revolution, let's say 100, 150, 200 years ago, the average price, gold to silver, largely because of gold's role as money and the logistics of it, has averaged roughly 42 to 1 price. The geologic ratio has always been 16 to 1 until now. My good buddy Keith Newmeyer, who I believe you know, and he's told me personally on at least 3 or 4 occasions, and publicly just a couple months ago at the Rule Symposium, that what is coming out of the ground right now globally is 7 to 1. So it's depleting to the point where you're only getting 7 ounces of silver out of the ground for every 1 ounce of gold. It's been 16 to 1 for thousands of years. The price ratio, because of logistics and monetary applications, has been roughly 42 to 1 for almost 200 years, even though it was 16 to 1 geologic ratio, right? Now you get to a point where you have this massive expansion in demand and a depletion in geologic availability, stockpiles in the ground, and we get to a 7 to 1 ratio, yet it's priced at 80 to 1. And it's priced at 80 to 1 because there are a couple of banks on the COMEX market that have the largest concentrated short position in any commodity traded on COMEX. So why the hell would they do that? Why such a concentrated short position? Massively concentrated short position. They are trying their darndest to keep it from rising in an environment where everyone is accumulating it. India imported 304 million ounces of silver last year. That's 10 times more than the registered category on COMEX holds. Those are the bars that are available for delivery. And if you talk to people like Ted Butler, probably the foremost expert on the COMEX market and its relationship to silver, he will tell you there is a growing, very, very large growing shortage of industrial-sized 1,000-ounce silver bars. But it's not just in COMEX that you're seeing these bars delivered off the exchange, copious amounts. We're seeing same thing happen in the London Metals Exchange. At the beginning of the year, they told us if the deliveries continued the way they did last year, there'd be no silver left. We're seeing it on the Shanghai Metals Exchange and the Shanghai Futures Exchange. They had their biggest one-day delivery of silver ever last week or the week before. We're seeing backdooring out of the ETFs by the authorized participants, largely the commercial banks. So we are seeing silver disappear. We are seeing the price suppressed. Again, talking about the counterintuitive nature of the price. At the same time, the biggest money in the world is accumulating it and removing any and all counterparty risk by pulling it off of the exchanges. And I think it's the value of a generation. Honest to God, I believe it is the value, the play, the trade of a generation. And I don't say that flippantly. The United States Geological division of the government came out recently and said it will be the first item struck from the periodic table of elements. They said that within the next decade, all of the silver in Mexico will be depleted. You are seeing a depletion of silver, an increase in its uses, a suppression of the price. It is the trade of a generation. You look at everything since 1980, it's gone through the roof. Where's silver? Half of where it was in 1980. Does that seem right to you? Look at gold. It's just $100 basically off its all-time high. Silver's half of it. And yet it has more uses and needs industrially, militarily, and now monetarily than gold does. And it should be much higher. I think it's the play of a generation. What are the headwinds? The manipulation on COMEX, period. You have banks that are holding down the price for a reason. What the hell is the reason? It must be more important than we're being led to believe. But why put so much effort to the point where the guy that ran the metals desk and the head trader at JP Morgan were just sentenced to prison last week for suppressing the metals market, largely silver. And so when you talk about the importance of it, the price is being betrayed by the drawdown from the world's exchanges. And I guess I'll say it to you this way, Jesse. It would be far easier for you or Eric Sprott or Rick Rule, someone who could write out a check for $100 million, to give me a check for $100 million to buy silver than it would be to take delivery off the Shanghai Metals Exchange, off the COMEX, off the LBMA. You need to be massively sophisticated to do that. And so who's taking it? Where is it going? Why is it disappearing? It certainly is not indicative of its price. And I will go on record as saying I believe it to be the value proposition of a generation. Price be damned. The fundamentals are way, way, way distorted from the price. And I look at it as one hell of an opportunity.
Well, I want to present some statistics here and shout out to Michael Oliver from Momentum Structural Analysis, where I got these. And so from 1973 to 74, the S&P was cut in half, a global recession was in effect, and as the broad market tumbled, silver more than doubled. Fast forward 76 to 80, As the broad market mostly chopped sideways or declined from its 1976 lows, silver climbed from $3.80 to a high of $50.35. 2000 to 2011, a dozen years of up and down movement in the broad market that yielded no net gain, and silver once again outperformed, going from a little over $5 to $45 by July of 2011. Do you expect silver to perform similarly to these previous bull runs in the face of a broad market crash and recession?
Yeah, I think it might even outperform because of the uses that silver has right now in green and digital and military applications. Um, I think people put too much stock on the fact that it will slow down in a recession. Yeah, it is an industrial metal, but it's become a lot more than that, and I think people understand that. And even in a recession, you have a green agenda all around the world. There are people that are buying solar panels. There are people that are buying electric vehicles. There is a ever increasing need for silver in the military industrial complex, and silver's role is money. I think it will outperform people's expectations because really what we are missing in all of this analysis, and I love Michael Oliver too. He's one of my favorite, the momentum analysis. He's different than most everyone else in the way he views the world because of momentum. Incredibly smart man. So, Michael, you got my respect as well. I watch everything you put out too. Um, I think it's different this time, Jesse. I think ask yourself, why do we have three or four banks holding the largest concentrated position of any commodity traded? Why? Why is silver so important to hold it down? I don't understand it. Or maybe it's a little deeper. Maybe it is a strategic metal. And maybe that's why the U.S. has been suppressing the price to stockpile the crap out of it for a very long time and hide just how much they've been stockpiling. Why is the U.S. Mint, other than August when they produced 3 million coins because of the outrage that's been going on, why have for the last 4 years they produced hardly anything in the way of silver eagles? Are they stockpiling silver? There's a lot of whys and a lot of questions, but I think it will outperform maybe any investment out there because look at the fundamentals. You have an asset that is increasing in demand on multiple fronts, monetarily, industrially, militarily. You have an asset that is depleting in supply, in nature, going from 16 to 1 to 7 to 1 in terms of a mining ratio. You have an asset that when it is used, it is used. If you blow it up in a Tomahawk missile, or you have a fifth of an ounce, or in a motherboard, are you going to rip apart that motherboard to find a fifth of an ounce of silver that after labor and everything you go backwards? There's a kilo of it in a battery of a Tesla. Maybe they'll pull some of that up. But the point is the recycling of silver is minimal. Most of it is used in such small quantities, it doesn't make sense to recycle it. But when you talk about the gazillions of cell phones that have silver in it, little bits, or the computer screen that each of us are looking at each other on has a little bit of silver in it, or the motherboard on your computer has a little bit of silver in it, or all of the things you've touched over your entire lifetime, or any of us over the last 80 years has a modicum of silver in it. Where the hell is it all? How about this thing? Remember these things? Who the hell uses these anymore? I happen to have one. There's a little bit of silver in there. Tiny, tiny, tiny bit on the motherboard. Where is all that silver? It's in landfills. So when you talk about potential, honest to God, I don't think there's a better asset in terms of potential on the planet. Massive demand in multiple levels, not just one use. You have monetary, warfare, and industrial, and an asset that is depleting in nature, where only 3 out of 10 ounces come from companies that mine it. The rest you hope is found by companies mining for other elements and just stumble across it. On every single level, supply, demand, and historical price ratios or geologic ratios, it's an anomaly right now, the price. In my opinion, the price we have right now is so much an anomaly that I live in Delray Beach, Florida, on a golf course. And it's been the hottest summer. I've been here, this is my third summer. It's never been this hot. But if I woke up tomorrow morning, I'm from Minnesota, spent 50 years there. I have 2 snowmobiles in my sister's garage. If I woke up to 4 feet of snow this morning, I promise you, before I got on this podcast, I would not have called her and said, "Hey Betsy, send me my two snowmobiles, would you please?" Because I would know it's an anomaly. And the same thing is true of this price in relationship in every way, historically and geologically. It's an anomaly. So headwind, tailwind doesn't matter to me. Big picture, macro picture, it's the play of a generation. So yeah, I think it's what people should be looking at.
I spoke with our mutual friend David Morgan on the show recently, and he believes that although gold will recover first out of a recession and market crash, silver will ultimately outperform gold on a percentage basis. It sounds like you agree with that, given that you're calling it the opportunity of a generation. So is this a time that people should be accumulating silver? And what about the premiums? Because we've seen some quite high premiums on silver. Is that more of a reflection of its true value? And what would you say to those who want to accumulate silver but are turned away by the high premiums at the moment?
I'd say right now the premiums are the lowest they've been since 2019. I'd say right now is the best availability, price, and premium we've seen since the pandemic, hands down. I think that the premiums have been higher than I would have ever dreamed of seeing most of my career, for the last 3.5 years, 4 years. But that's changed right now. And it's very strange to me that we see such great availability and such low premiums right now. The people in this country, they focus too much on recency bias. They're afflicted by it, normalcy bias. The world is more screwed up than it's ever been, in my opinion. And yet the premiums have collapsed. I don't look at it as being something that will last. One of the things that not enough people talk about is the term bail in. And when the Dodd-Frank law was written, it said bailouts were illegal. When Silicon Valley Bank was bailed out, this is why the Republican senator from Oklahoma got so pissed off at Janet Yellen. He says, "You just bailed out these banks. That's illegal. The Dodd-Frank Act says so. What the hell's going on?" Well, the banks were too systemic, she says. The Silicon and Signature, too systemic. Well, he says, "Well, does that mean if a bank fails in Oklahoma, my constituents will be bailed out?" No, she says. No, 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 no. Has to be a uber majority decision by the FOMC, which is the Fed, the FDIC, myself, and the president. And so when you look at all of these banks that are hanging on by a thread, when you look at the rates that are rising and the banks have to sell their toxic assets on their balance sheet to meet redemptions as people keep running for the exits, wait until one of these banks gets bailed in, as the law says they're supposed to, where you become an unsecured general creditor of the bank, and anything over the bullshit FDIC limit of 250,000. And I call it bullshit because they have 125 billion in assets backing 18 trillion in deposits. It's bullshit. It's not a backing. It's an illusion. But anyways, wait until one of these banks gets bailed in. And that is the law. That's what Dodd-Frank says. The taxpayers will not be on the hook anymore. It is the depositors who are lending money in the terms of an unsecured general creditor to the bank. Anything over FDIC, they will lose. It will get bailed in, which makes me so mad about Silicon Bank. Do you know, as an aside, for 3 years, they had $14 billion in 10 checking accounts. For 3 years. Now, who the hell in their right mind would leave on average $1.4 billion in a business checking account with no FDIC insurance above $250,000, earning zero when they could have put it all into treasuries with no bank risk, earning 20 times what they were getting at Silicon Valley Bank in a checking account? Where was risk management of the bank? Where was risk management of these corporations? And where the hell was the FDIC then? Was this done to get the ball rolling and then we bail them out, even though it's illegal? They should have lost their ass. They should have lost everything. And that, we added 14,000 clients, Jesse, in 45 days in March and April. Premiums were going crazy then. And then the Fed papered it over and everything's okay. Wait until you see a bank bailed in this time. And the banks that are failing, we haven't even begun to see the end of it yet. And wait until one is bailed in. And it is one thing for you and me to sit here and say that the dollar sucks and the stock and the bond market's in trouble and the BRICS are going to do this and you better protect yourself. It's another thing when we talk about the piggy bank that you first remember as a 4-year-old kid putting your quarters and your allowance in and all that. And then graduating to a point where you open your first savings account and you're so proud of yourself and you're saving money. Well, guess what? It ain't safe. and everyone thought it was. And watch what happens when the majority of this country doesn't even know what the hell bail-in means. None of them do. I come across people every day who have no idea what it means. Watch what happens when a bank is bailed in. Watch what happens to premiums then. I will tell you, honest to God, the availability and the premiums right now are the best they've been in 4 years, unequivocally. And I think it's, again, very counterintuitive. People are very short-term oriented. They don't see the big picture. That's what I look at, the big picture. And we ain't out of the woods even close yet with the banks. And when that happens, you'll see premiums go right back to where they were. So for those wanting to buy silver now, it is the most advantageous we have seen since 2019, and I mean that to my soul.
We have been seeing both debanking and the freezing of financial assets be used as a political weapon. Looking back to the Freedom Convoy in Canada, where people got their accounts frozen, even people who donated to the Freedom Convoy. We are seeing political attacks against people like Nigel Farage and others in the UK being denied banking services. And now we've started to hear anecdotal reports of silver and gold coin shops being debanked. Have you heard about this scenario? As you are in the industry, are there any insights you could share with us? And is this something people should be worried about?
Well, I mean, yeah, anytime you see for no particular look, as far as the coin shops are concerned, we don't know the other side of the story. And I, there's two sides to every story. Now, I don't believe that this is something that's a good thing when the banks just unilaterally dump you. But coin shops don't employ the same type of regimented standards that a larger company like myself would do in terms of security protocol, KYC, know your client, AML, anti-money laundering. Maybe some do, maybe some don't. Maybe some have experienced theft. Maybe some have had problems that we aren't being told about. Now, I'm just trying to look at this from an open mind. If we see that, that's problems. This is one of the reasons no one wants to take the central bank digital currency, because instead of dumping you, they'll just shut it off. No, you can't do it. We're not allowing you to buy gold, period. So, yeah, I've heard about it. I haven't seen it on any major company, just some coin shops. And I'm not disparaging these coin shops. I'm just simply saying we don't know the whole story. Maybe we're seeing that more broadly, not just in coin shops. Maybe we're seeing that all around. You've certainly seen it with gun shops, and maybe we're seeing that in other businesses that these banks feel are not worthy of the risk. It goes hand in hand too. You're seeing not a lot in the way of lending. The banks would rather reel in their risk, give the money to the Fed, earning 5% interest with no risk, with safety. And maybe they're trying to get their books in order because they're all so deep in doo-doo right now, their balance sheets and their risk profiles. And this is one way to clean it up, get rid of the low-hanging fruit. If they came and did it to a major company like myself or APMEX or JM Bullion or SD Bullion, one of these companies that are respected and do things the right way, it's another story. But we're going to do $1 billion in transactions this year. Most banks would like to work with us because not only do we give them a lot of volume, but we also are very regimented in the way that we handle our business to make sure that we're doing things above board and legally and all of those things. And maybe those things aren't quite as stringent in a local coin shop. I'm just thinking outside my head. But look, anytime that the bank can just shut you down, that's a bummer. And the fact that it's happening to metals companies, which is gaining traction in terms of its visibility, it's a little disconcerting. When you start to see larger companies get dropped by their banks, that's when it's time to worry. But here again, if these things are rearing their head, be proactive, don't be reactive, and secure your position if that's the way you want to go before you see this validated with larger companies being dropped by national banks, or maybe just a real big banking crisis where something lights the fuse and everyone runs to the door. Look, you're seeing an incentivizing by the Federal Reserve, aiding and abetting these banks being destroyed. What do I mean by that? Well, they've been allowing for months now the money markets that are run by the large banks to invest in the overnight reverse repo market. They shouldn't do that. They talked about disallowing it. They haven't. So if you can let's look at the difference. In a regional bank right now, which Janet Yellen has told us will be bailed in, she said that. And that's the law. These banks that their balance sheets are upside down, as we all know, they bought treasuries and mortgage-backed securities over the last decade when they didn't have to hold virtually anything in reserves, earning 2% or less on treasuries and 3 or 4% or less on mortgage-backed securities that have lost 50% or more of their value. And if they have to sell them and not wait till maturity because of redemption requests, they don't have the assets, no reserves, they go upside down in 36 hours like Silicon Valley Bank did. But, if you realize that the best rate you're going to get in one of these banks is on a 1-year CD is 4.5%. The savings account is 0.5% on average across the entire regional bank spectrum. 4.5% in a 1-year CD, you're locked in for a year in a bank that will get bailed in, that is systemic, that has a horseshit balance sheet. Or you can transfer to a too big to fail bank that we all used to be scared of, but now we're told they'll be bailed in because they're too big to fail, where you can invest in a money market paying 5.5%, which is greater than the 1-year CD, but it has daily liquidity. You're not locked in for a year in a too big to fail bank with daily liquidity, paying more than you get in a regional bank. Who in their right mind would stay in a regional bank? And that's why you're seeing all that money leave. But the question then becomes, why are we seeing more money leave the big commercial banks than the regional banks? And why are we seeing the overnight reverse repo market being drained? Well, let's discuss that for 1 second. The commercial banks, there's the big money in the commercial banks say, well, geez, why don't I just go directly to the Fed, or to the Treasury rather? TreasuryDirect.gov, buy 6 month or less in duration treasuries, earning more than I can get in the bank here, and get rid of all bank risk. And that's what they're doing. They're pulling their money out of the banks. They're going directly to the Treasury. They're buying short-term duration treasuries and removing all systemic risk of the banks. They're betting on the safety and the health of the U.S. government over the banks. If the government fails, the banks are dead anyway. And when you see the reverse repo market being drained, it's the same thing. Because with China and Japan and Saudi Arabia dumping bonds, they need to find someone to buy the treasuries. So where is it coming from? Well, the same people in the overnight reverse repo market. It's not all money market funds, but the same people that are in there, the same organizations, they're saying, well, hey, why don't we just go right to the treasury? Because you can get close to 6% in a treasury now versus 5.3 in the overnight repo. Let's go to the Treasury and earn an extra, 700 basis points. And why not? When you're talking millions and billions of dollars, that's a lot of money. And you remove all systemic risk of the banks. So the point is that the banking crisis is long from over. And the Fed and the Treasury are aiding and abetting this. And, we talked about Jared Bernstein in the first podcast. He's the lead economic advisor for the U.S. government, the man who wants to shed the U.S. World Reserve currencies standard. Well, guess who's the number 2 in charge? Economic policy at the White House. Her name is Lael Brainerd. She spent time at the Treasury. When Powell was up for re-election or reappointment, she ran against him. She didn't win, but she was appointed vice chair of the Fed. She left, and she's now number 2 in charge of the Economic Advisory Committee at the White House. She's a modern monetary theorist whose whole theory is central bank digital currency. She ran Point for FedNow, which came out a few weeks ago. She dealt with MIT in developing the central bank digital currency. Biden wrote an executive order on that, and the BIS said every country has to have one by 2025. And if you take the entire world's GDP, the countries that make up 95% of it have one in production right now, every one of them. CBDC is coming. Well, Lael Brainerd wants that. Lael Brainerd wants to get rid of the banks. Lael Brainerd wants the money to be issued directly from the Federal Reserve so that fiscal and monetary policy come right from the Fed. And it's no coincidence, maybe, that they're aiding and abetting the exodus out of these banks. You can't make it up. One advisor wants to get rid of the world reserve currency, and as we talked about in the first episode, that's exactly what they're doing. I mean, or at least it looks like that's what they're doing. They're certainly not clinging to the value of being the world reserve standard and issuer. And then you have this other group that wants to get rid of the banks and go modern monetary theory and money come directly from the Federal Reserve and get rid of the banks. Well, sure looks like that's what they're trying to do. And you wait till one of these banks gets bailed in. Wait till a big regional bank like U.S. Bank or PNC Bank or Truist Bank gets bailed in, and watch what happens. The 14,000 clients we added in 45 days, which is almost 4 years worth of client acquisition, will seem like a walk in the park when people watch hundreds of millions and billions of dollars get evaporated just like that. And so, yeah, I don't think we've even begun to see anything yet. And the banks will be, in my opinion, the catalyst that sets off the whole fuse. And, you know, when I think about, is this stuff intended? Lael Brainerd, Jared Bernstein, could they actually be stupid enough to want this to happen? And it comes down to two things for me. One, 155 trillion in debt, 5 trillion in assets, 40% of which is student debt. And the fact that a central bank digital currency is coming, how do you make the people take it? Well, you create an event, blows everything up, where interest rates spike and the dollar collapses and asset prices collapse. In that environment, the banks collapse, it's panic, it's chaos, people lose everything. But when we talk about the unfunded liabilities, the Medicare, the Medicaid, the Social Security, the government military pensions, in a world at the same time where the biggest accumulators of the U.S. debt are selling it, who's buying it all? The U.S. public. They're running to the Treasury to buy the debt. The majority of all the debt owed to the United States or by the United States is to our own people. Everything blows up, but have no fear, Jesse. Lael Brainerd is here. Sign on the dotted line and you'll be made whole. Take the new CBDC. Because I'll tell you what, the people I talk to every day, short of something like that happening, there ain't one of them that would take it voluntarily. But you create an event where you've just lost the majority of everything that you own in terms of its value, sign on the dotted line, Jesse, and we'll make you whole. But you got to take the CBDC. Could that happen? Don't know. But I'll tell you something, honestly, when I look at the idiocy that I see around this country, the break in unification, the aiding and abetting of the destruction of the banks, the weaponizing of the dollar, the antagonizing of the linchpin of the dollar hegemony, Saudi Arabia, the weaponizing of the justice system, the FBI, I look around me and say, my God, I mean, are they looking for a villain? Do they want a villain? And who would that villain be? Oh, OPEC, Xi Jinping, and Putin. They did this to us, those bastards. How could they do it to us? And the people in this country will believe that. And if you want to have a villain and you want to reset the system and blame it on that villain and introduce your new CBDC, you couldn't have done it any better than the current administration is on the path to doing it. And the people advising them, it's what they want. Is it coincidental or not? I'll leave that up to everyone else to decide, but it goes through my mind every single day.
Well, Andy, thank you so much for joining us once again. An amazing couple of conversations. I learned a ton, as I always do when speaking to you. Before I let you go, could you tell people about Miles Franklin?
Sure. We've been in business now for 33 years. We've done over $9 billion in sales without a customer complaint. We are licensed and bonded, maybe one of the only major companies that is because of the Minnesota regulations where our corporate office is located. And we do things a little bit differently than most of the online companies. We're a hybrid model. We have a website, milesfranklin.com, where you can purchase up to $10,000 worth of gold and silver, or you can send us an email and please say Jesse sent me or VRIC channel sent me, and request a more competitive price sheet for larger orders, much more competitive, or ask questions on precious metals IRAs or any question you have. And with no obligation whatsoever, we will contact you. We will send you an updated price sheet that's more competitive than our website. We will answer your questions to whatever degree that you have them. And that's what we are. We're a hybrid model that isn't just about taking orders. All of our brokers have extensive experience. We have some that have degrees from Wharton and a master's degree from in business administration from Temple. We have 4 or 5 guys that were on Wall Street. Every one of the brokers in my company, all 14 of them are dear, dear, dear friends of mine. Most go back to elementary school. These would be my friends in and above business 100%, and they are. We're one big family. We are a family-run business that has never had a customer complaint. So we'll make damn sure the people who contact us, hopefully from this interview, would not be the first customer complaint we've ever had, but I'm pretty sure that they won't be. So again, that's info@milesfranklin.com for questions or a different price sheet, and milesfranklin.com just to cursory check us out and see what we're all about. But I got to tell you, I love being on the show with you. I love these conversations. I think this is maybe our fourth or fifth that we've done over the last several years, and you can always count on me at the drop of a hat in a world that seems to be spinning out of control faster and faster and faster, and things developing faster and faster and faster. Count on me to be available to comment on things at the drop of a hat. You're one of the good guys, Jesse, and it's an honor to be here and to be associated with you and Jay Martin and the Vancouver Resource Investment Conference, which really is one of only 2 or 3 that I will ever go to throughout the year. And I live the furthest possible distance away in the United States from that show in Southern Florida, but it's a good enough show. Jay's a good enough guy. You're a good enough guy. And everyone there is influential enough. And the show is meaningful enough for me to spend a day each way flying there. I wouldn't miss it. So thanks for having me. I look forward to seeing you up in Vancouver in January and hopefully talking before then if the need arises.
Absolutely. And I'll put a link to Miles Franklin website as well as the email in the description below. And we definitely need to get together at the VRIC next year. And again, hopefully before that, to get an update from you. Always enjoy hearing from you, Andy. And thanks so much for joining us today.
You stay well, brother. Look forward to catching up and picking up where we left off. Thanks again, Jesse.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.